Keep in mind that the estate tax system and the gift tax system are really a unified system. The estate tax system wouldn't work very well from the government's perspective if estate taxes could be avoided just by making gifts. So the federal gift tax and the estate tax, in a sense, are really one tax called a transfer tax. And just like there's an estate tax exemption in 2017 of $5,490,000, there's a gift tax exemption of $5,490,000. They're really the same exemption. If you use your federal gift tax exemption while you're alive, you won't have it at the time of your death. Keep in mind that both the estate tax exemption and the gift tax exemption are subject to inflation adjustments. They're indexed for inflation. When you make gifts, if it's a taxable gift, it will use up some of your gift tax exemption and estate tax exemption. So if you make a taxable gift of $250,000, then your estate tax exemption, assuming you die in 2017, won't be $5,490,000. It's going to be reduced by a value equal to the taxable gift. So it will be reduced from $5,490,000 to $5,240,000 because you've made a $250,000 taxable gift.
But you can make transfers that are not counted as taxable gifts. When you make small gifts, they're going to be excluded from the value of taxable gifts. That's called a present interest annual exclusion from taxable gifts. That's the $14,000 per year per donee exclusion from taxable gifts. What that means is you can give $14,000 to any person you want, and it will not be considered a taxable gift. And you can do that every year, and it won't be included as a taxable gift. This exclusion is also indexed to inflation. It's worth mentioning here Section 529 plans, because these plans take advantage of these present interest exclusion taxable gifts, and they're designed to receive assets that are dedicated to educational purposes. So lots of times grandparents will set up 529 accounts for their grandchildren to start an education account going. And these 529 accounts have some very beneficial tax factors associated with them. Basically, all the income and all the buildup in the value in these accounts are exempt, not just deferred, but actually exempt from income taxation if they are used for educational purposes. And the definition of what's an educational purpose is pretty broad, so it can be very beneficial. When the grandparent makes a transfer to a 529 account, that's considered a gift, and it can qualify for the $14,000 per year per donee exclusion from taxable gifts. But you're allowed to put more into a 529 plan account than just the $14,000. Basically, you can get 5 years' worth of gifts at the $14,000 level into the 529 account in 1 year, and it will be excluded from taxable gifts. It's a bit more complicated than that, but that is something that you should keep in mind. Also, other exclusions from taxable gifts are when you pay somebody's qualified tuition costs. That's an exclusion. So you can make $14,000 gifts to a person, and on top of that, you can also pay their tuition to an accredited college. And none of that will be considered a taxable gift. Same thing for certain medical costs. You can pay somebody's medical costs, and that won't be considered a taxable gift.
Keep in mind, just as there's a marital deduction for estate tax purposes, there's a marital deduction for gift tax purposes. So if you make a gift to your spouse, there's not a taxable gift no matter how big it is if your spouse who's receiving the gift is a U.S. citizen. If your spouse who is receiving a gift is not a U.S. citizen, then the gift is not deductible. It's a taxable gift if it exceeds $149,000. When talking about a gift to a spouse who's not a U.S. citizen, instead of a $14,000 per year per donee exclusion, in 2007 18, there's a $149,000 per year exclusion for gifts to a spouse. The exclusion is also indexed to inflation.
In our next and final segment, we'll cover gifts of life insurance policies and other gift-giving techniques.